Hello, and welcome to Managerial Accounting. My name is Dr. Annette Moultrie. And welcome back to Cost Volume Profit Analysis, or CVP. This is part two. And I do not own the rights to this content. All rights belong to the original authors, Miller Nobles and Madison and Pearson Education. So the information is used for educational purposes only. So let's get back to CVP. Remember, we said that cost volume profit analysis is a managerial accounting tool used to determine how changes in cost, sales volume, and price affect a company's profitability. So CVP helps businesses understand the relationship between their costs, the number of units they sell, and their overall financial performance. CVP. So we're beginning here with learning objective 2. Calculate operating income using contribution margin, unit contribution margin, and contribution margin ratio. So what is contribution margin and how is it used to compute operating income? Well, contribution margin is the amount remaining from sales revenue after you deduct the variable costs. So it represents how much revenue is available to cover the fixed costs and generate profit. So the contribution margin is equal to net sales revenue minus variable costs. So the contribution margin is often expressed in total. So here on your screen, you see the contribution margin is equal to net sales revenue minus variable costs, and we're using the information from Smart Touch Learning. So you have $500 per tablet times 200 tablets, minus the $275 per tablet, which is what the variable cost, times 200 tablet. So it equals to $100,000 minus $55,000. And it equals to $45,000 when you subtract those two numbers. So the contribution margin is commonly expressed on a per unit basis. It is calculated as unit contribution margin equal net sales revenue per unit minus variable costs per unit. The terms unit contribution margin and contribution margin per unit, they are interchangeable and they refer to the same concept. Here in this example, you have the unit contribution margin is equal to net sales revenue per unit minus variable costs per unit. You have $500 per tablet minus $275 per tablet equal $225 per tablet. Another way to express contribution margin is as a ratio. The contribution margin ratio represents the proportion of net sales revenue that contributes to covering the fixed costs and also generating profit. So it is calculated as you see here on the screen. Contribution margin ratio is equal to contribution margin divided by net sales revenue. Then you have your $45,000 divided by the $100,000 equal 45%. Or you can divide the unit contribution margin by the net sales revenue per unit, and you'll get the $225 per tablet divided by $500 per tablet, which will give you 45%. The traditional income statement format may not always provide sufficient information for managers, okay? So to address this, a contribution margin income statement is used. It categorizes cost based on their behavior. You have your variable costs and your fixed costs. Now, this format, it emphasizes the contribution margin calculated as net sales revenue minus variable costs, which provides valuable insight into the profitability and cost management. A traditional income statement categorizes costs by function. They classify them as either product costs or period costs. Now, the product costs include expenses incurred during the process or production of goods. For the company Smart Touch Learning, which is a manufacturing company, these costs consist of direct materials, direct labor, and manufacturing overhead. These costs also accumulate in the inventory accounts until the product is sold, at which point they are recorded as cost of goods sold. Now, the period cost, it includes selling and administrative expenses, which they're not directly tied to production. So with the traditional income statement format, it is required by GAAP, and it has been the standard approach in your accounting studies. So in contrast, the contribution margin income statement, it categorizes costs by behavior, either variable or fixed, and it also highlights the contribution margin, which helps in internal decision making. So if you take a look at the screen, you see the traditional income statement, whereas you have the net sales revenue minus cost of goods sold will equal your gross profit. That's a product cost. And then you have the period costs. You have the selling and administrative expenses, which will equal to operating income. And to your right, you see the contribution margin income statement. You have the net sales revenue minus variable costs, which will give you the contribution margin. And then you minus the fixed costs, which from the contribution margin, which will give you the operating income. Okay? Again, you see the traditional income statement and the contribution margin income statement. Okay? So the contribution margin format provides greater insight into cost behavior, which will help managers make pricing, budgeting, and operational decisions. That's the contribution margin income statement. Okay, so now we're going into learning objective 3. Use CVP analysis for profit planning. Using CVP analysis for profit planning. Okay, so how is cost volume profit analysis used? We talked about that just a little bit in part 1. Okay, so here we're going to see how managers use this information about cost behavior to make business decisions. We said that the CV analysis is a planning tool, right, that looks at the relationship among costs and volume and their effects on profits and losses. And we're still using Smart Touch Learning as an example, whereas they're using the CVP analysis to estimate how changes in sale prices, variable costs, fixed costs, and volume will affect their profits. So there are assumptions. CVP analysis is based on 5 assumptions. You have the constant selling price, which is the price per unit. It remains the same regardless of sales volume. For example, Smart Touch Learning, the company that we're using in this course, assumes that each tablet sells for $500. Now, the classification of costs, it's all costs can be categorized as variable. It could be categorized as fixed or even mixed. Okay? In the cost behavior and volume, the only factor influencing total cost is changes in volume, which impact variable and mixed costs. For instance, Smart Touch Learning assumes that variable cost per unit, or cost per tablet, I should say, is $275. That's what they're assuming, that the variable cost per tablet is $275. The other assumption is the fixed costs remain unchanged. Fixed costs do not change. Okay? So fixed costs stay the same regardless of production levels. So in this case, with the company Smart Touch Learning, it assumes that fixed costs are what we said earlier, $13,500 per month. That's what they're assuming that the fixed cost will be. And the other assumption is no inventory. There are no changes in inventory level. So the number of units produced equals the number of units sold, meaning there are no fluctuation, I should say, in inventory levels. Okay? So the number of units produced equals the number of units sold, and there are no fluctuation in the inventory levels. Now, while real-world business conditions rarely align perfectly with these assumptions, managers, they use the CVP analysis as an approximate tool for decision-making rather than an exact measure. Break-even point, 3 approaches. Now, CVP analysis can be used to estimate the amount of sales needed to achieve the break-even point. Now, the break-even point is the sales level at which company does not earn a profit or a loss, but they have an operating income of 0. Okay? Now, required sales can be expressed as either a number of units or as a total dollar figure. So we're going to look at these 3 methods of estimating sales required to break even, which are the equation approach, contribution margin approach, and the contribution margin ratio approach. These are the 3 approaches that we'll be looking at now. So here we have the equation approach. Now, we can further break down total cost into its component, which are the variable and fixed costs. So an equation can be used to estimate the number of units a company needs to sell to achieve target profit or total sales revenue. You have net sales revenue minus the total cost equal operating income, but of course you have the net sales minus variable costs minus fixed costs equal operating revenue. We'll look more into the equation approach in the next side. Okay, so net sales revenue equals the unit sales price, which is $500 per tablet in this case, and it is multiplied by the number of units sold, which are tablets, okay? The variable costs equal variable costs per unit, which is $275 in this case, times the number of units, which are tablets sold. So this company fixed cost total $13,500. That's $13,500 per month. So if this company desires to break even, then their total profit is 0. Okay. So Smart Touch Learning must sell how many tablets? 60 tablets per month to achieve their break-even point. Expressed in dollars, the company must have total sales of $30,000 per month. That's 60 tablets times $500 per tablet. The next approach is the contribution margin approach. Now, the contribution margin approach is considered a shortcut method of computing the required sales in units. So previously, we proved our answer using the equation approach. So now we can rewrite the equation approach to be fixed cost plus target profit divided by contribution margin per unit, which will equal the required sales in units. So the required sales in unit is equal to the fixed cost plus target profit divided by the contribution margin per unit. Now, using the rewritten formula, we can enter the given amounts to calculate the required sales in units. So when the dollars cancel out during the division process, the result is expressed in units. And here you see on your screen, you have the required sales in units equal fixed cost plus target profit divided by contribution margin per unit. And to put the dollars in place, you have the $13,500 plus 0, which is $13,500, divided by $225 per unit, which will equal 60 units. We're still talking about the contribution margin approach. Here on this slide or this screen, it illustrates how we can prove our answer using the contribution margin income statement format. Okay? So you have net sales minus variable costs. You have your net sales at $500 per unit times 60 units, which is $30,000. And then you have minus variable costs at $275 per unit times 60 units, which will give you $16,500. Then you have your contribution margin, which is $225 per unit times 60 units, which will give you the $13,500 minus fixed costs of the same amount, $13,500. Now your operating income is equal to 0. Okay. So now we're going to enter the contribution margin ratio approach. The contribution margin ratio approach. Now, some companies, they can use the contribution margin ratio approach to compute required sales in terms of sales dollars rather than in units. Okay? The formula is the same as when using the contribution margin approach, except that the denominator is the contribution margin ratio rather than the contribution margin per unit. So here in this example, you have the contribution margin ratio is equal to unit contribution margin divided by the net sales revenue per unit. You have your $225 per tablet divided by $500 per tablet, which will give you the 45% contribution margin ratio. So if we were to do this in dollars, you have your fixed cost, well, the required sales in dollars, you have your fixed cost plus the target profit divided by the contribution margin ratio. So you have your fixed costs of $13,500 plus the target profit, which is 0, divided by the contribution margin ratio, which is 45%, will equal $30,000 of required sales in dollars. A variation of the break-even profit calculation is the target profit calculation. Now, target profit, it is the operating income that results when net sales revenue minus variable and fixed costs equal management's profit goal. So the same 3 approaches can be used. The only difference is that a company uses a target profit instead of the break-even point of 0. Here in this exhibit, you have the target profit calculation for Smart Touch Learning. Okay? Using all 3 approaches. And here, in this example, the management profit goal is $4,500 per month. Okay? So let's look at the equation approach. You have the net sales minus variable costs minus fixed costs equal target profit. You have $500 per unit times unit sold minus $275 per unit times unit sold, minus $13,500 equal $4,500. Okay? And it all computes to units sold, which is 80 units. With a contribution margin approach, you have the required sales in units equal fixed cost plus target profit divided by contribution margin per unit. And if you plug in those numbers, you will get your 80 units. 80 units. And here with the contribution margin ratio approach, you have the required sales in dollars equal fixed cost plus target profit divided by contribution margin ratio. So you have your $13,500 plus the $4,500 divided by the contribution margin ratio, which is 45%, equal your $40,000, which is the required sales in dollars. Here, this table that you see, it illustrates that the company Smart Touch Learning can reach its profit goal of $4,500 per month if it sells 80 tablets per month at $500 per tablet. So the cost volumes are CVP. This graph that you see here, it illustrates how varying sales levels impact profitability. So to create this graph for Smart Touch Learning, we have to plot the following, which are: one, sales revenue line, which represents the total revenue at different sales volume. Okay, that's what you see here in blue. Then you have your fixed cost line, which is in orange, right? It stays constant regardless of sales. And then you have your total cost line, which is represented with the green line, okay? So that includes both fixed and variable costs. So the break-even point is identified where the sales revenue line intersects the total cost line. So that's the point where total revenue equals total cost. In this case, the break-even point occurs at how many tablets? 60. The break-even point occurs at 60 tablets, or let's slide over to the left, $30,000 in sales. Okay? Next, we mark the two key areas on the graph, which are operating loss area, which is left of the graph, right? It's left of the break even. Here's the break even. Okay. It's left of the break even, which is the operating cost, loss. Okay. Now, total costs exceed sales revenue, resulting in a loss, which is the orange zone area. Okay? Operating income area, this area right here, it's the sales revenue. You see the sales revenue? It surpasses what? Total cost, leading to what? Profit. Of course. Whenever it's green, that's profit. So in this case, managers find that the CVP graphs, it's valuable for quickly estimating profit or loss at different sales level. While formulas for target profit calculations provide specific income or loss figures for a single sales volume, the CVP graph offers a visual representation of financial performance across multiple sales levels. Okay, and this is the end of part 2. This is the end of part 2. So we covered learning objective 2 and 3. Thank you for watching, and please do not forget to click the like and subscribe button. And if you have any questions or comments, please leave them below and I will reply to you.